Good morning and welcome. Today we're going to dive into the world of stock market strategies, but don't worry, we'll keep it straightforward and simple. We're looking at something called a short call synthetic straddle. Now, I know that sounds incredibly complicated, a bit like a technical puzzle you might find in a weekend newspaper. However, the core idea is much simpler than its name suggests. Think of it as a way of combining two different actions: owning shares in a company and selling a specific type of contract on those shares to create a particular financial position. So, what is the main purpose of this rather intricate-sounding strategy? Is it about buying low and selling high for a big capital gain? The answer is no. The short call synthetic straddle is primarily an income-generating strategy. Think of it less like selling the house for a profit and more like renting out a spare room for steady monthly income. The income comes directly from the premium you receive when you sell the two call options. You collect two premiums deposited to your account. This is the central aim: get paid to take on a defined obligation at a strike price. You're not chasing explosive growth, you prefer a calm, predictable stock. Cement this idea. The profit is the premium you collect up front. Every option has an expiration. As time passes, time value decays, theta, which benefits the option seller. Your goal is for the calls to expire worthless, so you keep the entire premium and perhaps repeat the process. Every strategy has its season, a market environment where it succeeds. What kind of weather? Stormy volatility or calm, predictable waters? The answer: calm, predictable waters. This thrives when a stock is stable and trades in a narrow range. It's neutral. You don't strongly expect up or down. Volatility is the enemy. Structure: you own 100 shares and you've sold two call options. One call is covered by your shares, a covered call. The second is a naked call. That naked call carries theoretically unlimited risk if the stock shoots up. A sharp crash can also hurt. Your 100 shares lose value. Ideal: a mature, stable blue-chip company, predictable, liquid, not prone to dramatic surprises. It's a bet the market takes a rest, and you get paid while it does. Now, let's move from the theoretical to the practical. To make this work, choose the right underlying: stability and predictability, not a speculative tech or biotech awaiting a binary event. A company like PepsiCo, Pep, is an excellent example. A global consumer defensive with steady demand. Familiar brands, steady revenues, regular dividends. Charts often show gentle trends or sideways consolidation, not jagged extremes. High liquidity in shares and options means tight bid-ask spreads and smoother entries and exits. News flow is frequent but rarely earth-shattering, less dramatic post-earnings volatility. You can form a reasonable 30-45-day view based on stable nature and history. This makes a blue chip like PepsiCo a strong candidate for an income-focused, low-volatility strategy. Let's walk through a hypothetical example using PepsiCo. Imagine today is the 8th of October 2025, and Pep trades at exactly $170 per share. You expect no major events and a 30-day range between 165 and 175. You already own at least 100 Pep shares. Choose an expiry about a month out, 24th November 2025, and the at-the-money $170 strike. The 170 call sells for $4 per share. Sell two contracts. Remember, one contract when sold 100 shares. You receive 4 bucks $100 $400 per contract. Two contracts collect $800 credited immediately. That's your maximum profit. Position: long 100 Pep, short 2 170 calls. You're obligated to sell 200 shares at 170 if exercised. Now, the waiting begins toward 21st November. Perfect outcome. PP closes at 170 on expiration. The calls expire worthless, and you keep the full $800. Knowing the theory is one thing. Executing is another. First, you must already own at least 100 shares of the underlying. One of your two short calls is covered by those shares. A common risk control requirement. Open the option chain. A list of calls and puts with strikes, expirations, and premiums. Income traders prefer shorter terms, typically 30-45 days, balancing time decay and premium. Select the at-the-money strike nearest the current price. Execute. Sell to open 2 call contracts at your chosen strike and expiration. Example: sell to open 2 PEP 21 NOV 2025 170 ton calls. On fill, the premium, $800 in our example, is credited and the position is open. Double check before confirming. Ticker, expiration, strike and quantity so as to avoid costly mistakes. Once you've entered and collected your premium, the position is live. It's a waiting game, but monitor price into expiration. Ideal, the stock pins your strike, $170, and the calls expire worthless. You keep $800 and retain your 100 shares. If PEP falls toward 165, your short calls lose value. Good, but your 100 shares lose too. Downside break-even, initial price minus premium minus premium. 170, 8, 154. Below 154, you're losing overall. If PEP rises to 175, shares gain but your short calls lose. Watch the naked call risk. Upside break-even, strike plus premium. 170 plus 8, 178. Above 178, losses can mount. Set alerts near 154 and 178. You can buy back the options anytime, e.g., sold for $800, buy back for $200 a week later, quick $600 profit. Every trade needs an exit plan. Best, let options expire worthless if PEP is at or below $170 on 25 November. Many close before the final week to avoid gamma risk. Have a target, capture 50% of max premium, then exit. If PEP jumps to 179s, above 178 break-even, prudently close, buy back both calls and sell your 100 shares. If above $170 at expiration, calls likely exercise. You sold 2 contracts, obligated to sell 200 shares. You own 100, broker may short 100 on your behalf. Complex and risky. Discipline to lock profits and cut losses, another reason many close before expiration. And there we have it. We've journeyed through the short call synthetic straddle and demystified it. It's an income strategy, not a capital gains one. It works best in low volatility, sideways markets, with careful stock selection like PepsiCo. Keep learning, consider paper trading first, and know your risk tolerance and goals. Thank you for watching, and see you next time.